very long week, but we made it to the end. Yay. So I was able to share the AM edition of the Founders Note. And if you put it, really, if you read yesterday's PM Founders Note and the day before's PM Founders Note, you'll notice they did talk about those end of day flows that came in Tuesday and Wednesday that were, it came in at like 320. And some of it was attributed to end of quarter flows, because not only is March done this week, but this is the last trading day of March, it's also the last trading day of this quarter. So yeah, I'm still setting up the stream. It'll take just 1 minute. But if you want that question answered of, what do those flows mean? Or what can we do with those flows? Or, were there any implications because of those flows? Check out those founders notes. I thought they did a really good job of kind of explaining the flows. And one analogy that they used was, imagine walking a tightrope or trying to balance on top of a fence and walk on the fence. It doesn't take very much to push you over, right? One direction or another. And they kind of attributed those big flows that came in on Tuesday and Wednesday to exactly that. Now, Wednesday it popped up, but on Tuesday it fell over. So either way, nice analogy. It's worth reading. I think it'll kind of explain those flows a little bit. So good morning. Good morning. The had a heads up that there's some new people watching. This is not a beginner's stream by any means, but always feel free to ask questions in the chat. I won't answer them live during this stream, but I will answer them later. And I will send you some links to some of the charts that I use and a little bit of a guide that explains what I'm going to be going through. So if I discuss something you don't understand, just ask in the chat, but don't expect me to answer during this stream, because if I sat around answering questions all day, we would still be here when the bell rang, right? So let's take a look at what's going on. Kind of put things in order here. Hong Kong down 0.25%. This should hit those China ADRs that we watch constantly. BABA, Baidu, JD, PDD, NEO, XPEV. Just kind of throw them all into one category. Not down by a lot, but we're really not expecting much out of the market because we're still in hurry up and wait mode, right? A lot of the things that's going to move the market is tomorrow. So we could see a little bit of hand wringing today with the flow of the market, but we're still not expecting a whole lot. Ranges should hold as we go into the end of the quarter. Having said that, though, we've seen 2 days in a row of massive flows coming in end of day using MOC orders, market on close MOC. And a lot of that's attributed to non-discretionary funds who don't get to choose, right? The VC funds, volatility control funds, they have to allocate based on what volatility standards are, and they don't get to decide if they're going to buy at all-time highs or sell in the depths of the lows or just straight up rotate out of it at the end of a quarter. So we're going to see some flows today, and it might break things loose like we saw Tuesday afternoon and Wednesday afternoon. So just kind of keep that in mind. The hurry up and wait on the range that we've been playing all week, approach that concept with caution if we start getting some big flows. NASDAQ's down less than 0.25%. The Dow, the S&P, and the small caps just back to back. And it's not often that we get them all tucked in together like that in one space. And that's really another reflection that we're just not doing anything yet. Japan is up the most, which is not a surprise. It's continued to dominate. But even with Japan, it's barely up 0.5%. So the whole world is watching, waiting to see what we're going to get out of this data this week. We're going to get some jobs data that goes directly to what Powell kept talking about in the FOMC meeting. Some home sales data. We've been discussing that quite a bit lately. So anything to do with home data, you're going to want to keep your eye on. And then some consumer sentiment. Now, those sentiment ones, you got to kind of take them with a grain of salt, but they're going to be watched. So, you want the numbers. You'd think this thing would remember me, so I wouldn't have to keep doing that. All right, we're going to get some GDP data. Let's see what else we got in here. We got some additional auctions today at 11. Be mindful of the fact that there's sometimes auctions that don't get listed on like FX Street or even in Finance Juice. So if you spot one, just go ahead and assume there's probably others. This one's at 11:30. That means there's 3 places you can get auctions: 11, 11:30, and 1 o'clock. If we're seeing one at 11:30, just go ahead and assume there's probably some others. Even if you don't know what they are, just watch the clock, right? You know when a new candle's coming in, half-hour candles, 1-hour candles. We've had this talk multiple times this week. Lots of data coming out of Japan tonight, and this is a really big deal too. Remember, Japan is changing something that's been going on for decades, and the markets don't like uncertainty, and there's still a whole lot we don't know about what's going to happen with Japan and how that's going to affect things around the world. Watch in the afternoon. We're going to have some late for Europe, some late speakers. European Central Bank Villeroy is going to be speaking at 12:30. On this website, it actually uses my own time zone, so I'm betting this is 1:30 market time because I'm an hour behind. It just posted the European market wrap. This is handy. You can come back to this website all through the day. When we close, there'll be a market wrap. Probably in another 30 minutes, they'll actually have a pre-market briefing posted here. It's a really useful site. Plus, if any of this data comes in that is deemed noteworthy, this site will keep up on it really well. So it's one to keep around all day. This is a lot of data. Got a lot going on. And just like I mentioned, check that out. There's some additional auctions that we weren't seeing on the other side. So we've got some really close front end auctions, the 3-month, the 6-month at 11. Then we got a 4-week at 11:30. I'm pretty sure there's one at 1 o'clock, even if we're not seeing it here. And since all of these are up in the front end, you could look at something like the IRX. It's a really close end. That'd give you a better kind of basket view. Look at the IB from last night. Everything is tightly wound. This just, again, demonstrates our hurry up and wait scenario. This is a very narrow, very tight range. We're building up a lot of pressure sitting here like this. Equilibrium. think about the idea that liquidity resides on the other side of the pivot, right? So if you took a short across these highs, where's your stop? Outside this box that I just drew. And if you took a long outside of the lows, where's your stop? Right? Outside the box. And really, until that breakdown right there, this was the low, right? So if you went long here, you had to stop out of the box. If you went long here, you had to stop out of the box. So what happened? We went down here and took that liquidity. Dun, da, da, da. A draw, which draws everybody in, and then a raid, which raids the liquidity. It looks like they didn't get enough, so they're going to make another pass at it. But when you have markets in a really tight range like this, it's building up energy, something that we didn't normally refer to for a long time until an indicator came out called the RSI Laguerre. It's in my Discord under the Thinkorswim workbook. You can find different versions of the RSI Laguerre. The guy who really pimped it out for Thinkorswim, his name is Mobius. He built a lot of different versions of that RSI Laguerre. Energy is not something that we generally use as a word for the market. We usually say momentum, trend, inertia. But energy, on the other hand, we started learning with this indicator. If we use an analogy like a ball, go out in the yard, you throw a ball, the energy that you put in that throw makes the ball move. But as it's traveling, it's losing energy and it falls. Take a ball to the top of a very tall building, drop it. As it falls, it picks up energy. So when a market is moving, we kind of need to know, is it moving with energy behind it, like I threw a ball? Or is it moving like when we drop a ball off a building, picking up energy as it moves? That indicator that I mentioned tells you which one it is. Another thing that we learned with that indicator, though, is that when we're sitting sideways like this, the market is actually building up energy, like charging your phone, putting gas in a car. This thing is winding up more and more and more energy. So when it makes a move out of this box, it will be moving with energy behind it. Very much like me throwing a ball rather than dropping a ball off of a building. Now, there's no direction implied in that, and you could attach something like a squeeze indicator. Squeeze would tell you whether or not volatility is compressing. It wouldn't necessarily tell you that the candles are compressing. We can see the candles are compressing. That's obvious. But are we compressing volatility? There are also a couple of telltale signs. See the wicks across the top here. They're getting a little longer. There was some wick dynamics along this side until we broke down through it. If we were to bring up a TPO chart, maybe a volume chart, if you're on Trade-Evate, for an example, TPO volume chart, Thinkorswim has monkey bars, anything like that. You could dig deeper into the liquidity that built these wicks out. But for all intents and purposes, it looks like they're bringing down the flows a little bit at a time, and that we're going to get a bottom side breakout here and really start to expand. There's still a need for a catalyst, right? The hurry up and wait that we've been running has got us nowhere at this point. We are exactly where we were at the start of the week. So, last Friday, we went into the close at 52.90, and here we are just, 13 points away from that. So we've done nothing. We've gone nowhere all week. A big old hurry up and wait. Markets don't like to hurry up and wait. If we do it for too long, they'll just throw up their hands and wash the whole thing and start over. But we're kind of getting the wash anyways because it's the end of the quarter. Volumes are kind of light, but no worse than they have been all week. We could see on Monday where we're sitting at around 71, Tuesday at 60, Wednesday 61, and this morning at 59. So they're on the lighter side. And this is the first day with all this light volume that we actually have a market maker move. They're hedging. They're concerned. Want to keep your eye on that through the day and see if their concern lasts all day, or if they're really just hedging up through the front part of today's data that we're going to get. Remember, there's a lot of data, right? There's a lot of data, especially the jobs data. Any jobs data that we get right now is going to go directly towards the Fed and the possibility of a cut or not. And the Fed is pushing back more on their supposed promise of a cut later, right? The message is we're going to stay high for longer and not cut yet. If you don't have this market maker move tag on the platform that you're using, go into the options chain on Thinkorswim. You can always find the market maker move. If there is one today, you can always find it right here. If there's no market move today, then you just won't see anything there. That's a defect I've asked them to change. They don't care what I have to say. They haven't changed it, but that's where you would want to locate it. So if you're on a platform that does not have that, what you want to do is go into the options chain and look at the last or the front expirations. If the implied volatility average is greater in the front than it is the next series out, then you have a market maker move. All right, it's not supposed to be this way. It's supposed to be low and then kind of go higher as we come out. So if you look, we got 7s, 8s, right? And then we get into 10, 11, 12s, a little bit of shenanigans here where kind of gets a little mix up, but then back into the 12s, 13s, 14s, 15s. It just goes higher as we go. So where do these 10s come in, right? We're really heavy in the front end. These numbers are developed by a proprietary system that they don't tell us all of the different things that it's made out of, but we know some of what it's made out of. They take all the implied volatility of the out of the money options on both sides, the calls and the puts, and then they average that together, mix it up with the square root of time, do a little bit of other kind of math, and they get this number. The only reason that that's important, that I bring it up, is because where's the hedging at? Well, they hedge out of the money. So they come in, they trade a bunch of options out of the money. That hedging activity jacks up the implied volatility average. It causes a market maker move so that we can see, hey, they're hedging. So they're hedging. They're worried. If they're worried, you should be worried. This hedge implies that big moves could come, big moves like yesterday afternoon. Rather than everybody trying to scramble all at once, if they're long, trying to get out and go short, if they're short, trying to get out and go long, they can just hedge. And then it doesn't matter if the market goes up or down, they're covered, right? But a hedge is cost. It's expensive. It's not free. It's not a trade like a retail trader would use a hedge and just use it for a trade and maybe make some money out of it. It's just cost, like your house insurance is cost. You don't use your house insurance for profit, right? You're not hoping for a tornado to rip your home apart just to get a paycheck. So same thing when you insure a trade. You're not hoping the market crashes and burns just so that your losing trade will kick off and pay you with your insurance that you bought with your hedge. So if they're willing to spend the money on it, they're worried. The thing is, we don't need, or we're not guaranteed to get a big move. If enough of them hedge, they'll hedge it so much that there's no big move. And the reason for that is generally we get the big move because there was people caught off sides and they had to scramble, and then everybody was trying to buy at once or everybody was trying to sell at once. But if they don't have to scramble and there's nobody caught off sides, then there's no reason for the really big move. And you'll see this all the time on FOMC, CPI, PPI, where everybody hedges it to their eyeballs and we get one initial big move and then it just unwinds itself and we get the gap close play. So earlier this week, I mentioned this turnaround, and I had a lot of feedback, and I appreciate all of you that had something to bring into it. Yes, we hit a lot of different pivot points. I'm not even going to list them all, but it was more than one. We didn't hit anything that attaches to this chart, right? To this volume profile, to these volume shelves. So when I mentioned the other day that I don't know what we hit, that's really what I was referring to. There are pivots, though, that we did hit and measured moves, and all of the feedback was excellent. I love it. It shows that you know what you're doing, and I feel good about that because I kind of feel like I had a part to play in it. Keep doing what you do. We are looking now at an adjusted TPO. So you got the volume profile in green, and we got a TPO, time price opportunity, in blue. While both of these look like a volume profile, they're not. They're two completely different things. In the volume profile, we're still above the point of control. We managed to cut through it yesterday when those big flows came in at 320. But in the TPO, we've popped up. And what this is saying is we've got more volume by time here. And it's by time because TPO is time, price, opportunity. TPO, that's a TPO profile. So we're going to be expecting to see this green volume profile point of control move up to our new location. But it's so far behind. We can see how far behind this volume is just nowhere near ready, right? We have not been getting the volume at this level that we should be. So this is a little bit of a discrepancy that I'm interested in keeping my eye on. I want to see more. I definitely want to see some volumes coming in here, but we're not likely to stay here for much longer. The longer we do stay in this very tightly wound spot, the more energy we're going to build up, and more energy and more energy. So I marked out that VPOC yesterday and didn't use it as a VPOC, just a POC. I wanted to see if price reacted to it anymore after we had already hit it. And there was a couple more times, if I went into a smaller time frame, we'd see how we responded around it. It was worth keeping an eye on it through the day, but we're done with it. And it wasn't a VPOC at that point. That's why it was orange. It's just a POC. But we do have a new VPOC down there. So the V stands for virgin, untouched. It hasn't been hit. It's a point of control that has not been hit since that day closed. So we can see yesterday's price action is closed, and we have not come down and hit this since it closed, which is why it's called a VPOC. Now you go in and start studying volume profiles. A lot of books will tell you to carry forward this value area high, the value area low, and the point of control. Whether or not it's been hit at all, they'll tell you, well, just carry it forward. Use it in today's session. I've already got enough pivots. I don't need just arbitrary pivots that I'm bringing forward from another time frame. I don't need it. I've got enough. If you don't think you have enough, bring them forward. There's a lot of value to it, especially, if you're just getting started and you want some pivot points. I've got enough, but what I do want to carry forward is this untouched point of control. Those I'm interested in. And if we take a look at, what we've been keeping track of, we've got a few overhead, at least one more that we're likely to hit if we continue this drive higher. And we've got a number of them from down below. So if we do, not if we do, but eventually when we do go back down there, we'll take them out. Otherwise, today's point of control really highlights how tight this range is. It's a very narrow, tightly constructed zone. And if we were to turn on the regression line starting right at 6 o'clock, you can see that there's a mild slope in there. That's the mean, by the way. So we are trending lower slightly, very, very slightly through all of this choppy mess. It kind of highlights, even if you didn't know about that tool, the high set here, barely an equal high and a higher high, and then a matching high here. But look at these lower highs. So you can kind of see it, but it's always better to be able to bring up a tool and confirm it with math, because I like math. As discussed, everything that we've done this week was a whole bunch of hurry up and wait. A lot of running around where we really haven't accomplished anything. It's exactly where we're at. This tool is ignorant of the fact that there's no market tomorrow. So it doesn't know that today's the last day. It's just a quirk of Thinkorswim with tools like this. By Monday, everything will be fine. But for right now, this thing thinks that there's still a market tomorrow. And so we're not seeing next week's range like we normally would at the end of the week. Little habit I've been getting into lately is marking where the price is above the 10 so that we can see it on a day-to-day basis. Did we go higher than yesterday, lower than yesterday? Especially on the weekly when we've been riding above the weekly since that QRA back in November 1st. We're still there, still riding above 3.5% above the 10-week. That doesn't look to be changing anytime soon. Flip it over to the daily and bring it in a little bit closer. We've been maintaining this schedule, this range, and so far nothing has changed. We are less than 1% above the 10-day, which means we're not overbought. We haven't moved too far, too fast. Even with that drive late yesterday afternoon, it didn't get us into any sort of overbought conditions or anything like that. On a week where the market really has done nothing, it's worth taking a look at this. The top three are the risk on sectors, the bottom three are the risk off sectors, and the three in the middle are midline sectors we would expect to do good in a good economy or a bad economy. The tag here is changed over the last 5 days. And sure, it hasn't been 5 days yet, but it kind of gives us a feel for what's going on out there. And we can see the candles over the last few days on what we have been doing. And it's not just the S&P and the NASDAQ that's kind of been going sideways, doing nothing, right? It's not just them. It's almost everything, except for utilities, I guess, and healthcare. And, oh, hey, look at that, staples. So we're getting a little bit of a rotation out of technology. We're getting a little bit of finance, some consumer discretionary. But the big push really starting to come in down along in this bottom. Look at that strong gap up and close at the high of the day. Same thing with healthcare, same thing with utilities. So those look really good. Into the quarter, we're going to be getting into a earnings season, starting the cycle all over again. That kicks off with banks. It's not going to be a surprise if we start seeing more and more on the bank side starting to pick up. I do have a few moving averages in all of this mess. Take a look at finance, industrials, and staples. And that orange line, that orange is a 50-period moving average, and it's solid as a rock on all three of those. Now, sure, we start to zoom out, we can see that these others are holding relatively well above their 50, but the 50 isn't so ruler straight as it is on those three, right? And you could throw technology in on that too. The others either have some sort of curve where it's starting to flatten out, or has some sort of curve where it's starting to pick up and maybe get into the shape of these guys. Even things like consumer discretionary, where it's been tested and threatened a lot lately. On these three, they're nowhere near their 50. They look like railroad tracks just riding along that Linreg line. Whereas in consumer discretionary, which is really dominantly Tesla, Not only Tesla, but for a while, that's seemed like all it was. A lot more testing against that 50. Take something like energy, the 50 is just barely crossing back up above that 200. It's a 5,200 cross. It's a really big deal. Um, depending on the books that you look at, they've got names for this kind of cross. It's been around for so long. It's a biggie. But it also kind of highlights the fact that energy, which has been holding in a range forever, might just be finally starting to come out of that range. That's copper. We don't need copper. This is that range that I was talking about for energy. We're on a weekly chart here, going back even just a year and a half. We've been holding this level below, call it 93, and above 68, just chopping about. So if we're actually going to make a run for it, we could be seeing oil run up into the high 90s, $90 a barrel. I'd have loved that when I was working on the drilling rigs. I'd have took that in a heartbeat. They tend to start laying people off under $60 a barrel. At least they did before we were energy exporters. So TradingView's adjusted their watch list and screeners. I'm going to do a little work in here over the weekend, but they have one exclusively for ETFs, right? So I went to the ETF screener and they already had one built for extended hours. It made it really simple. Now I haven't cleaned this up yet. I'd like to eliminate some of these Bitcoin things that are in here, but this is a really nice way. And it does what we normally do anyways, right? It would normally look at the ETFs that are up in the morning. This is just a broader perspective of that. So I'll get it cleaned up and I think I'm able to share it, which will be nice once I do get it cleaned up. They've been doing a lot of work on their scanning process. It's good to see. Their heat map is not quite responsive enough yet. Change percent, knocked it down to 94 names just by market cap. And of course, if we want to, we can adjust the multiplier just a little bit so that it will change color faster. Yeah, that'll work. But we're still not really getting much of anything this morning. It's such a flat market out there. Hurry up and wait scenario. So things that are up this morning, Bitcoin proxies are what I would focus on since the rest of the market is just kind of stagnant, waiting on data. Then I would go after Coin, Hut, Mara, Riot, Hood, anything that has any connection with Bitcoin. Now, careful, earlier in the week, we had Bitcoin moves and the proxies paid no attention to it whatsoever. So it doesn't owe us moves in the proxies. We're just looking at Bitcoin and saying, well, if Bitcoin's moving, we should see something out of the proxies. That's better than a hopeful hurry up and wait, cross your fingers that the SPY is going to move. So we got Bitcoin, got China ADRs up now. They were down earlier, or we saw that China was down earlier. So with the China ADRs, the K-Web up, then we could take a look at things like BABA, Baidu, JD, PDD, and see if we're getting a lift in those. We can see here on BABA, it's a 15-minute chart. We got that gap up, and so far it's holding. So China ADRs, JD, big gap up. I'd be careful with that one. Baidu, a less aggressive move to the upside. So we got the China ADRs. We started to get some Bitcoin stuff. Here's Riot, but it already rolled over and got the gap closed. That's not necessarily a bad thing, but I don't like that it tried an inside day breakout and then failed. I do like that it tried to come down and get this gap. Now, some analysts do gaps different than I do. It's not right or wrong. It's just which way do you want to go? For me, if it closed here and then it opened way up here, that is the gap that needs closed. It's not closed until it goes back to that line. That's just the way that I do business. Other analysts will use that candle. And if we come back and touch that candle in any way, even if it's just across the top, then that gap is closed. It's not right or wrong. It's just which way do you want to go. If you pick one, though, you need to stick with it. Don't arbitrarily decide this time it's a gap close because it touched the candle, but next time you're not going to call it until it gets down to where it closed before. Just stick with one for at least 6 weeks. And if you don't like the way that that goes, then swap to the other one. That you can certainly do. You're not married to it forever. So this didn't quite get the gap closed, but I don't like the breakout failure already. Mara got the gap closed, but again, it had a breakout and a failure. So a lot of the just straight up Bitcoin ETFs look like they're doing pretty good this morning, but the proxies and the Bitcoin miners and those don't seem to be doing so hot yet. That would be something worth keeping an eye on for a change. I'll bring up the Bitcoin list and see what we can get out of it. Yeah, we can see a lot of these Bitcoin names that ETFs made by like BlackRock, Fidelity, all of them now, right? They all have one. But we also got things like MSTR. It's so far as keeping that gap up. Coin, you know, Coin closed at the low yesterday. A lot of these other ones that we've been looking at least closed near the high. So sure, Coin is gapped up. It's moving around a little bit, but I don't like that it closed at the lows consecutively at these lows. There was some news on Coin too yesterday, I believe. Some kind of new government fight, another fight, some on regulation, I believe. So more hand slapping, probably. But that accounts a little bit for the negative look on that chart. Mara, same thing, gap up, gave it back. So they're not looking that good, even if they are up. I would look for these now, all of these that have gapped up and then pulled away from it. They need to run back up and break their own gap. Right. And then if it's Mara, which I wouldn't mess, or if it's Coin, which I wouldn't mess with Coin, but if you do want to, use a half back. Right? Just get the entire measurement of yesterday from high to low, mark the line in the sand. If it can get through the half back, then you could try a long back up to get the gap closed. You'd also want to perhaps keep your eye on all the other proxies that go with Bitcoin. AMD, PayPal, NVIDIA, all those other goodies. This is a very dangerous day, so I can't stress enough. Be careful, be cautious. Don't feel like you have to trade today, right? You're not going to miss anything if you just sit out, study, go do something else. We can see this very tight range here. And the longer we stay in this range, just winding up energy, the more likely the move is going to be very violent. And that there's no bias in direction here, right? It's not giving us clues on which way to go. Everybody, enjoy your long weekend. Be careful, be safe. I'll see y'all tomorrow, Monday.